No one realizes that energy runs everything. They just take it for granted. So when this collapse happens, when people start to move into physical gold and silver to protect wealth, there is almost the same amount of physical silver out there in investment demand, investment supplies, stockpiles, as there is gold. So I think the value of silver will move up much higher in percentage terms than gold. We could see a 10-to-1 ratio or higher.
Our back up the truck moment is here. Just $10,000 into Keith Neumeyer's last two deals could have been turned into $1.8 million for investors. Now he's going all in with a gold acquisition company, a precious metal mineral bank. We consider this a gold portfolio must. Learn more at futuremoneytrends.com/fortune.
Hello everyone, and welcome in to crushthestreet.com. Today we are going to get a complete breakdown of the diminishing returns on debt and why the US is undoubtedly headed for a massive crash. And the man to take us down this journey today is Steve St. Angelo of the SRSRoccoReport.com. And you know what? He's one of the leading experts researching energy and metals and their correlations to the real economy. He's affiliated with the bullion dealer Cloud Hard Assets. And you know what? I got to tell you, in the pre-interview here, Steve told me something regarding silver that is probably the most bullish statistic I've heard all year long regarding it. And he's going to share that with us today. But first of all, Steve, thanks for coming on the show.
Yeah, thanks, Kenneth. It's always a pleasure. You know, I think, unfortunately, some precious metal analysts are I've heard the talk is they're running out of things to talk about. You know, that's the chat out there. Is it because they don't know what else to talk about? You know, it's the same old thing. My problem is there's too much to talk about. Things are changing, and then when you look at all this data out there, we could talk for hours.
You know what? We're going to talk today about certain things that no one else is talking about. And in fact, some of the stuff that we're going to be pointing out are things that analysts are missing. As you pointed out in a recent interview, you broke down the diminishing returns on energy, on what's invested. And again, you're going to have to explain this for the audience. But with these numbers that we're seeing, and no doubt the economy is stalling out, when it comes to the energy that is being produced, oil production, we need more and more debt. Again, Steve, please share, the thoughts that you put down in this recent article.
Okay, Kenneth, it's a very complex but simple understanding. Animals, plants, animals, humans, corporations, and empires all base their survival on energy returned on investment. It's also like profits. You have to have more profits. If you don't have profits, you have debts, then you go bankrupt, unless you're being bailed out by the government. Well, it's the same thing with the energy return on investment. Now, when the United States started producing its wonderful oil in the early 1900s, 1930, let's say, it was producing 100 barrels of oil for the cost, or let's say the energy equivalent of a barrel of oil. So we had 99 profitable barrels of oil. Well, this continued to fall, but we became a little more efficient with it. We started using technology, and production continued to increase in the United States. Well, then it fell to 30-to-1 in 1970. Well, what's interesting, Kenneth, that year the United States peaked in oil production, and the very next year the United States, Nixon dropped the gold dollar peg. Right. Now, ever since 1970, the energy return on investment of U.S. oil and gas has continued to fall. And now shale oil, from what I understand, is 5-to-1. There's only 4 profitable barrels of oil compared to 29 profitable barrels in 1970.
And of course, the debt is being used to make up the difference, and that's why we're seeing that exponential growth in debt in the United States. Please continue, Steve.
Yeah, and the reason, let me explain the reason for that is every barrel of oil has thousands of energy slaves. We used to do, everything was manual, human or animal labor. Then we used wood and then coal in the 1800s. Well, then when oil came on, oil had all this wonderful energy in it. Basically, they're energy slaves. So we could do a lot more. Now, to have a modern society such as the United States, we have a massive infrastructure. We have highways, roads, bridges, waterways. We've got sewage and water treatment plants, telephone, internet now. All that costs energy. Well, when you have a high energy return on investment of your energy source, you can have all that. But when it starts to fall, you run into big problems. And now you see the energy return on investment of shale oil, even though we're producing 4 million barrels a day of it or more in the United States, it's low, 5-to-1, doesn't pay the bills or the profitable barrels of oil to have health care, education, entertainment, shopping, strip malls, all that. Technology. People have to remember, technology doesn't provide energy. Technology consumes energy, and the more complex the technology, the more energy it consumes. So in order to keep business as usual in the United States, we've been importing high energy return on investment from Saudi Arabia, from the Middle East, and elsewhere. But that's falling as well. But to maintain our standard of living that needs a 20 or a 30-to-1 to be prosperous, we've added debt. And this debt now is becoming unsustainable. So this is the problem we're at right now. And I mentioned to you in the pre-interview, we know things are getting unstable quickly because the global bonds out there, the amount of bonds that are now negative interest rate, from what I understand, is $13.5 trillion. Negative interest rates, never been there before. And this is double in just 6 months. I think if you go back to the beginning of 2015, there were very little negative interest rate bonds. Now there's $13.5 trillion. And so the issue is, Kenneth, there's so much debt now. It's like a huge balloon ready to burst, and we can't pay the interest or service the interest on all this debt, so we have to lower the interest rate, and it's now becoming unsustainable.
So, Steve, it's no doubt that we're borrowing a tremendous amount of economic prosperity into the future, and one of the things that we can talk about here is supply and demand of oil. If there's a lot of demand for oil and there's a shrinking supply, the price should go up. And that's what we need in this economy, as you've pointed out to us. But you got to explain to us why this, and just like you explained to me, is not going to be the case for the U.S.
and the world. And there's new information out, and I've been conversing with these gentlemen. They're oil engineers and project managers, and they think the price of oil is going to collapse. It's going to head towards zero rather than head towards infinity or $200-$300 a barrel. And I used to think that way years ago. But the economic principle of supply and demand is a human principle on economics using nature. And so if let's say there's too much supply, the price falls until demand comes back up. Then when demand comes back up, the price starts to rise. Well, these gentlemen are saying that thermodynamics supersedes the human-based economic principle of supply and demand. And what has happened is that the net energy available, or the net oil available to society, continues to fall, just as like we spoke about. We spoke about in 1970, there was 30-to-1. That was a very profitable energy return on investment. Now shale comes in at 5-to-1. Heck, oil shale, which we supposedly have a lot of in Utah and Wyoming, it's less than 2-to-1. It's not even economic to pull out of the ground. So the issue is this net energy that's falling doesn't allow our system to continue. So basically, we're going to see, as they say, a thermodynamic collapse of the oil industry as well as the GDP. And I'm actually going to have these gentlemen on in an interview in a few weeks to discuss their theory. But it makes a lot of sense. They could be off on their timing, but I don't think their timing is off by decades. It may be off by years. So they see the price of oil falling to $12 by 2020 due to what it's really worth to the society because of this rapidly falling energy return on invested. And I also mentioned to you the reason why we have seen the price of oil go to 100 in, let's say, 2011, stay there for 2012 and 13 and part of 2014, was because the Federal Reserve and the banks were shooting all this liquidity into the market, as well as lowering interest rates. So the shale industry was getting capital or investment because people couldn't get any yield in the bank anymore. Money market accounts were very almost infinitesimal percentages annual returns. So where did they go? They went to these higher risk, higher return investments, which were in shale. Unfortunately, they didn't make any money in shale. And let me tell you this. I've got a chart here, not of the shale oil companies. They're losing a lot of money. I got the top 3 U.S. oil companies: Chevron, ExxonMobil, and ConocoPhillips. We all know those names. Now, there's this idea that peak oil is a grand conspiracy thought up by the elite and the oil companies. I believe Lindsey Williams talks about this. He says it's a big conspiracy. Well, that would be true if the oil companies were making money, Kenneth. But if we go back to 2011, that's just 5 years ago. In the first half of the year, these 3 oil companies, after they paid their capital and their dividends to the shareholders, they had $16 billion left over. This last 6 months, after they paid their capital and dividends, Kenneth, they were $18 billion in the hole.
Wow.
How can an oil company survive when it's borrowing money to pay dividends? So the issue is people need to wake up. The oil industries, the major oil industries, are in big trouble. And these gentlemen from the Hills Group and Lewis Arnault, they say that they believe by 2000, in the next 10 years, the global oil industry will have disintegrated, and that 75% of the U.S. gas stations will be closed.
Wow, that's some serious claims right there. Steve, I do have another thing I want to ask you about regarding shale oil and fracking, but I think we'll get to that towards the end of the interview. I want to get to silver here. You've got some analysis here where you're expecting global silver production to peak at 28,000 metric tons a year. And, we're essentially there because last year we were at 27,500. By 2025, you were expecting the production to literally fall off a cliff, though, and go down to 7,500 metric tons, per year. And that's a collapse of 75%. And this is extremely bullish for silver because of the collapsing energy production. And not just collapsing base metal mines, but literally, the energy production. So please share your thoughts on this analysis.
Okay. Of course, analysis can be wrong, and the precious metal community, we were wrong. We not wrong. We just didn't realize what the Federal Reserve and the central banks could do since 2008. The prices of the metals went up to, and peaked in 2011, and we thought that they would continue. But the liquidity was pushed in stocks, bonds, and real estate, where 99% of investors have their money, because only 1% of investors, if that much, invest in gold and silver. So that's where the liquidity went into, and that's where all the shenanigans went to. So all these assets out there are propped up. And to do that, we threw a lot of debt in the system. Now, to keep this thing going, we have to add even more debt. To add even more debt, the debt goes exponential, and then it becomes unmanageable because you can't service it. And so when that collapse happens, then capital. You see, people say, well, we'll do a debt jubilee, which in the old days, you write off all the debt. They'll say, Kenneth and Steve, You don't have to pay your mortgage anymore. We're going to write it off. And you go, well, great. So now I can spend that money doing something else, you know. Unfortunately, when you get rid of the debt, you get rid of the assets on the other side. Some people are waiting for that money to come in every month. If they don't get that, then their assets implode. If assets implode, Kenneth, so does capital. So if you don't have capital, then you can't continue to produce oil. So oil production just falls like a rock. And then we have what I call the mother of all deflations. But it won't be in gold and silver, because here's the clincher. Because everybody in this, from what I understand, 250 trillion, and this is a figure put out by the banking industry. That is what's invested in globally: stocks, bonds, real estate, and insurance funds, mutual funds, pension plans, all that. 250 trillion. And that's based upon a continuation of burning energy, creating positive economic growth to pay it off. Well, when that doesn't happen anymore and this debt becomes unsustainable, then all those things start to implode. Well, the only real physical assets that hold value are gold and silver. Much better than platinum, palladium, and even copper. But copper could be a store of value. But so the thing is, to me, I see silver, if there's a pretty good chance we're going to see a collapse of debt by 2025. I don't think the system is going to be sustainable until then. And it may even happen well before that. Things are changing quickly. So when that happens, base metal production will fall like a rock. And we will see production continue to decline at a very quick pace. And this is what happens in nature. This is the way things happen, Kenneth. When they build up, Seneca Cliff is the increases of growth are sluggish, but the way to ruin is rapid. So we're not going to have a very slow drop-off of GDP, oil production, and metal production, kind of like a bell curve. No, it's going to be like a shark fin. And I've said this several times, I think, in the past with you. That's the reason why silver and gold production will probably collapse much quicker than most analysts are forecasting.
Steve, you gave me a statistic before we got started recording here, and it was probably the most bullish statistic I've heard all year regarding silver, and I'd love for you to share that with everyone today. Again, you know, people, no one else is talking about this sort of stuff, and you know, you're bringing this to the table.
Well, according to the official data out there, and that's the best we can go by. So there's probably a percentage of it out there that we don't know about, but it's probably true for gold and silver. But according to the analysis I looked at, up to 2015, there's about 2.2 billion ounces of gold investment out there. That's central bank and private investment. I think it's like 30,000. It's a little bit more private investment than central bank. Let's just put it that way. 2.2 billion ounces. Now, silver, get this, all the silver out there that's in bars and coins, held, let's say, in different ETFs, if it's there, it's actually 2.5 billion. It's only 300 million more ounces. And we've been producing in the world about 10 times more silver than gold. The difference is when silver came off as money, coinage, starting in the earlier 1900s, but then in the United States in the 60s, that silver was melted, put back into the system, and used a lot of it in industrial demand. And industrial demand has been the number one consumer of silver in the world. And most of it is gone. It's either in landfills or it's still being used in homes. It's used in switches and electronics. It's gone forever. Very little bit of silver is recycled. Even industrial silver is recycled. So when you look at those numbers, and they could be off a little bit, but it's a pretty good figure. 2.2 billion ounces of gold out there compared to 2.5 billion ounces of silver. But here's the clincher. The current value of that gold is $3 trillion. The current value of that 2.5 billion ounces of silver is $50 billion. It's 60 times less, 60 to 1, or thereabout. So the thing is, when the market wakes up, when the 45 years of fiat monetary amnesia, Americans and other folks wake up to this collapsing energy return on investment, which no one really knows about. They think oil is made by the tooth fairy, this is a saying by Lewis. So no, they believe, no one realizes that energy runs everything. They just take it for granted. So when this collapse happens, the assets that most people are invested in won't be worth it. It'll be like the biggest bag holders in history will be invested in stocks, bonds, and real estate and insurance funds. And so when people start to move into physical gold and silver to protect wealth, there is almost the same amount of physical silver out there in investment demand, investment supplies, stockpiles, as there is gold. So I think the value of silver will move up much higher in percentage terms than gold. We could see a 10-to-1 ratio or higher. I'm not saying we'll get there, but that's what my common sense analysis tells me.
Wow. I mean, and the slightest move into silver could send it skyrocketing. And I mean, that's what I'm taking from those numbers. Steve, let's talk about the shift that's going on. And, let's talk about the relevant news coming out of China. Why is China currently pushing for an SDR-backed bond? Is it because the RMB is about to be included in the SDR basket? And, what is the significance of this? Is this a real win for China, tying itself to the West, essentially?
Well, you see, there's two things going on. There is the older, how should I say this? There's the older central bank, even though the Chinese are a little bit more wise than the West. There's this older, slower tactics of economics and finance that continue to this day. That these leaders are not looking at the energy return on investment. So to get China into the system where they are more, and they need to be, because they produce a lot of the goods in the world, and they're one of the leading powers now. They want to be a part of the SDR, and there's a lot of talk about it every which way. However, the issue is they're going to be. And it's October 1st is when they will be a part of this new SDR basket. Now, from Tom Cloud, who's now associated on my website, he's a precious metal dealer for the last 40 years. He said in a recent update, precious metal update on my site, that according to a great source of his out of Europe, which he's known for like 35 years, says that there may be a big surprise that the Chinese, to get in the SDR, they have to announce how much gold they have. Even though they made an official announcement before of several thousand metric tons, they're going to have more of a higher official announcement. And this source thinks, from what he has heard, it's going to be higher than the United States, or what the United States supposedly has, which is like 8,100 plus metric tons. This is not a guarantee, but this is kind of what has been heard. And if that happens, if China does announce more gold than what the U.S. has, there's going to be a sell-off of U.S. Treasuries. And I think there's going to be a sell-off of U.S. Treasuries even if the number comes in lower than that, of what the Chinese have. And they probably won't be telling the total truth until the situation in the financial world gets unglued. But I think U.S. Treasuries are going to sell off because now we have a Chinese Yuan in there. And from what I understand, there's like 10,000 banks, institutions, and companies that will now be using the Yuan in trade. So why would you need dollars? So I think we're going to see some serious things happening towards the end of this year due to that change, and I think it's just going to get more volatile. And things are volatile, as you know, enough as it is right now, Kenneth. So I think this is very good for owning physical precious metals.
Yeah, it certainly is. I mean, and there's certainly a convergence of events, especially going into fall here, and seasonally we know the fall is a good bullish period for the metals because of buying coming around specifically in India. But I'd like to get your thoughts on the seasonality of gold and just how it relates to everything that we've been talking about, and and what you are expecting.
Yes, it's true. Seasonality buying of gold, especially gold and silver, has changed and is the strongest in the latter part, starting in September and going into October and November, and that's due to Indian festival buying as well as China. However, the Indians have disappointed us this year in their silver and gold purchases and imports. They're down substantially compared to last year. And I think there are several reasons for that. The price heading higher, and I think the issue this year, even though seasonality will be an issue, we will see more demand. I think the overall or more important factor is going to be the Chinese SDR. And that will be above and beyond the increase of gold buying in the latter part of this year. So I do think, I mean, look what happened to President Obama when he went to China. It's being all talked about on mainstream. They didn't even bring the ladder out to the Air Force One, and so it seems as if now the United States is really disrespected by some of the top powers. I'm not saying whether I agree with it or not, but I do believe they think because the United States has the U.S. dollar printing press, it's getting old. We can create all this money, and everybody else has to react to it, and it's very unstable. So I do think whatever the Chinese do announce with the gold they have, and now their inclusion in the SDR balancing, we're going to start to see a much different financial system after October 1st. And I think things are going to change quicker, and I think the U.S. dollar is going to be in more trouble.
Steve, I want to get back to shale oil here and talk about this. And it's a question that I had regarding the pressure on shale oil, because we're seeing earthquakes in areas that never really used to get earthquakes. Recently, Oklahoma had a 5.6 magnitude earthquake comparable to the hazards that California is used to. And I just want to get your thoughts on this. Is this going to add more pressure to the oil production collapse?
Yes, I think so. And it's been going on for years now, and there's been a lot more damage, not major damage. We're not seeing towns just falling apart, but there's a lot of structural damage that cost a lot of money to repair, whether it's infrastructure, homes, businesses. And it's documented. Now, I speak with a president of his own small oil company in Texas, and he fills me in on a lot of things. As a matter of fact, he's been doing this. He's been looking for oil for the last 35 years plus in Texas, Louisiana, and Oklahoma. Knows most of the people looking for conventional oil, and that's the profitable oil. That's the real high energy return on investment, as well as the high profitable oil that actually helps the community. Shale oil does not help the community. It's a big problem. He tells me that there's been a lot of damage, and what's happened is this: it's just not the fracking. It's not the to drill a let's say a horizontal shale well. You drill down like 5,000 feet or more, and then you put these laterals out there. It's horizontal laterals, and then you frack. That really isn't the problem. The problem is getting rid of all the wastewater and doing that. So in the past, when we had conventional oil production, we still, as the oil well got older, Kenneth, it produced more water. So they would grab this water and they would inject it in these shallow wells. And that was done up until, let's say, a few decades ago, or about a decade ago. It was now, as shale has come on, there's a tremendous amount of water for wastewater from shale gas as well as shale oil production. And what they've done is now the deep water injecting this wastewater. It's going down very deep, 5, 8, 10,000 feet into let's say, formations, geology in the ground. So they're taking all these old oil wells as well as a lot of these new shale wells, and they're injecting this wastewater deep in the geology. And what that's doing is it's actually acting as if you're putting oil on the road. And, you put oil on the road with a car or a person, you slip. So the geology is slipping now. And what is really important for your listeners to understand, there has been some studies about the impacts of deep water, wastewater injection. And the worst earthquakes, the highest magnitude earthquakes, can happen a decade after the water has been injected into the ground. So we haven't even seen the worst earthquakes yet. I think they'll be coming in the next 2, 3, 5, 10 years. So they are already shutting down wells. Any wells that you see, they're not shutting the oil down. They're shutting the wastewater. Well, if you shut the wastewater, you can't produce the oil. So the oil industry in certain areas of Oklahoma have been shutting down these deep water injection wells that are close around where these earthquakes are taking place. But it's still a very small percentage of the deep water, wastewater injection wells. And there's, people are very upset because their homes have been, have structural damage. There's been a lot of damage. And there's actual lawsuits out there. There's big lawsuits. And, the oil industry in Texas, well, it's worse in Oklahoma because of the geology, but they don't want to hurt their industry. So it's a political problem now. You don't want to hurt the industry, but you're destroying homes and businesses and infrastructure because of the deep water injection. And really, there's no place to get rid of this water. There's so much of it. You can't leave it in above ground tanks or above ground reservoirs because it's toxic. It's got a lot of different, very toxic elements in it. So this is the issue, Kenneth. Shale is a very bad deal all the way around. It hasn't really helped the energy companies. It really hasn't helped the United States because all the damage of the roads, because you need like 40 semi-tractor trailers moving equipment just to make one gas or oil well work. Well, a lot of that trucking destroys roads. Well, according to the data in some of these states, like in Texas and in North Dakota, the tax revenues received from the shale oil companies doesn't even begin to help pay the damage of all these county roads. So again, here's another example of why falling energy return on investment of the shale oil isn't paying for the system anymore. So what we're going to continue to do, Kenneth, is we're going to continue to add more debt until we can't do that anymore. Now, is that another year, 2, 3, 4 years? Might be just a couple years, but it's not going to be decades. And so this is something that's going to affect everybody, I would say, in a relatively short period of time. Because look what's happened since 2008. It's been 8 years since the last collapse of the U.S. investment and housing market.
Steve, you make an articulate case for what is yet to come, and it is inevitable. Hard to know if it's imminent, but it's certainly inevitable, as you put it. And again, no one else is talking about this sort of data and bringing it to the table the way you are. So I greatly appreciate you coming on the show and sharing this with our audience. Steve, is there anything else that you were hoping to get to today that we didn't talk about yet?
Well, one last thing. I always heard, Kenneth, that I always thought that our debt was increasing on an exponential trend. And for those who are not too familiar with exponential, all it is a doubling every time period. So let's say this year it was 2, next year it's 4, or in 10 years it's 4, then it goes to 8, 16, 32. It goes up, and pretty soon it goes straight up. That's exponential. Well, to what we understand about exponential, graph moves or movements, they collapse. They can't do that. Once they start going straight up, they collapse. And it's happened in nature. So you don't want to be on an exponential increase. You don't want to do that. That's a bad deal. Well, my recent article on the one chart that should drive investors into buying gold and silver, I actually looked at the information, compared the increase of the U.S. debt to what an exponential increase is, and guess what? If we doubled the debt the U.S. had in 1971, which is $393 billion, not much compared to today. If we doubled it every 10 years, in 2016, it would reach $9.5 trillion. That's the exponential trend. Wow. Kenneth, right? That's $19.5 trillion.
It's double that.
It's beating the exponential trend double. This is very bad news, and I didn't realize it. I always assumed it was kind of exponential. I didn't even think it was. But it's worse than exponential, which means our debt is on a trajectory that's a collapse. So, again, that's just another piece of information for precious metal investors to understand that the debt that's created all these assets, it's a big bubble. And lastly, I would encourage any of your listeners and readers to check out the website, the SRS Rock Report website. If you're considering buy precious metals, I think it's a great idea to call up Tom Cloud. His information's on my site. You don't have to buy metals from him, but I believe he's one of the most reasonable dealers in the industry, lowest cost, as well as storage. And they could talk to you. They're not hard salesmen. So I think it's a great place to understand more about purchasing precious metals. And we are going to have that interview with these gentlemen about this supposed thermodynamic collapse of the oil industry. And that will be in a few weeks. So I just wanted to tell your listeners about that.
Absolutely. Steve, it was an absolute pleasure speaking with you today. Again, thanks for coming on the show.
Dan, always a pleasure. Thanks a lot. Look forward to doing it again.